Second session is
I was threatened with bodily injury if we don't keep this on schedule by the organizing people, so I want to make sure we try and keep the time. Hi, Art. Hey. Art's with Kettering, by the way, and formerly GMI. Anyway, thank you all for coming this afternoon. This is the panel on early stage funding. We've got people in the panel that run the gamut of early stage, from Bill Grogan, who's a local venture capitalist, to Jody Vanderveld, who runs the Grand Angels, who's going to talk about angel investing, to Mike McCurrick, who is with Biotech Business Consultants, who have a state program to help early stage companies, entrepreneurs with obtaining federal grants. There's Skip Sims, who's with Ann Arbor Spark, who's going to talk about some of the state programs that are available to help you fund your early stage businesses. So what we're going to do is we're going to start from the venture capital side and work backwards, just so you can get an idea of some of the different things that are available. Dale, take it away.
Great. Thank you all for being here. I see that there are a couple of venture capitalists in the room, so I have to be sure that I tell the truth at all times, right? I was going to start off saying that the life of a venture capitalist is very, very easy. You go into the office at 10 o'clock, you have some coffee, you cash a few checks, you listen to a perfect pitch, and you collect checks. It's just like that. Am I right, Frank? That's how your fund works, right? The rest of us schlubs have to work for a living, right? So the perfect idea of a venture capitalist, the perfect pitch for a venture capitalist is a guy that comes into your office and says, this is my third startup, my 2 last exits generated $1 billion in value. We have absolutely proprietary technology that is earth-shaking or disruptive, and oh, by the way, we have our first customers in line. That's a perfect day. And that does not exist. It does not exist at all. But there are some things that we do look for as venture capitalists, and they're pretty standard across the industry. And so I'll cover the 5 Ps of venture capital interest. The first one that we look for is people. We're always investing in people. And as an early stage venture capitalist, we don't have the ability to look at a company or an industry or the track record of this business. So we have to look at the entrepreneur. So the entrepreneur has to have some credibility, he has to have some experience, he has to have some gravitas, and quite frankly some scars to have been in the business. And failure is not a scarlet letter. In fact, it's something quite the opposite. So the people matter. The second P we look for is potential. We look for market potential, that the market size is something that's enormous and is growing. So we want to look for something that has a $1 billion market opportunity as compared to $44. There's a difference, however, between total addressable market. You hear that thrown around in business plans all the time. We have $1 billion total addressable market, except 90% of it is outside the U.S. and we're only in the U.S. So the total reachable market, from our perspective, is much more valuable. And don't ever tell us that if we get 1% of the market, we're going to be rich. Or if everybody in China buys just one, we'll be rich. Because that doesn't happen either. The third thing we look for is, so it's people, potential. I'm Rick Perry now, I forgot. Very close, Department of Commerce.
Energy department.
That's right, okay, energy. Right, that goes to passion, that's number 5. It's the product itself. Is the product itself innovative? Is there something about this that is earth-shaking? We don't want model number 13 that's in purple as compared to green or red. We want something that does it better, cheaper, faster, right? That's what we have to see. We don't want another left-handed widget in the market. And then number 4 is protection. Is there intellectual property around this invention? When you're looking at early stage investing, that's really all we have. We have the people and we have the protection. Because there's not a large asset base that we can look at. There's not a string of trailing 12-month revenues that we can look at. So we have to look at the protection, and it has to be defensible, and it has to be direct, right? So not one patent that protects a slice, right? It has to be a body of patentry that works around this. And then the last one, of course, is energy, right? Or passion. You have to care about what you do. If you don't care about what you do, we don't care about what you do either. So you have to demonstrate it, and you have to articulate it, and you have to do it in a way that we understand. So we care about the business process as compared to the product. It's really great if the light turns from blue to green, if that means we can make money. Right? Tell us about how you sell the product, who the buyer is. Describe the customer as compared to how the thing works. Right? Remember that is a means to an end for us because we are dispassionate investors. And when you look at the metrics around venture capital, it demonstrates that this is our stock and trade. It's not that we want to invest in businesses that only do life sciences deals. It's because we have experience in life science, and that's where we find great returns. So if we talk a little bit about the inside workings of a venture fund, it may shed some light on this. The national metric is 1 in 100 venture capital deals get funded. So for every one of you in this room, one deal will get funded by us. But it is 5 times more likely to be successful than one that does not. And the reason I would say is because of accountability. As dispassionate investors, we demand accountability as compared to Uncle Ralph, who says, oh, you missed the benchmark and it costs a little bit more, here's some more money. We're not going to say that. We're going to say, why in the hell did you miss it? If you want more money, we're going to have to take a little bit more because you didn't do what you signed up to do. So that's part of it. The other issue is the process that we go through is fairly regimented. Our due diligence process is pretty specific. So for our fund, we do mostly life sciences deals. So our advisory boards and the folks that we bring into the deals are mostly scientists or folks that have been in this business. So we have to understand what we are investing in. If we can't understand it and the entrepreneur can't articulate it, then we'd be a fool to write a check. That just doesn't work. So we're fairly limited in what we do. The last comment that I want to suggest is that the scale of the investment matters and the scale of the opportunity matters. So if a venture capital fund wants to get a 7 to 10 times return on its money, then you have to have a significantly large enough return so that the math works backwards. For example, let's say we invest $1 million in your company and we bought 10% of it. You've got a hell of a deal. So you've got a $10 million company. We give you $1 million. When you sell the company, our 10% has to get us $10 million. So that means your company has to sell for $100 million. So we've got to have the size. So there are a lot of companies that just don't make the venture capital cutoff, not because they're not good companies, but just because the size of them doesn't work. So if it's not a case where we can do our math and our ownership will get us a 7 to 10x, then we can't be players. And that 7 to 10x is unfortunately not going to occur on every company. It's going to occur 1 time out of 10. We're going to have 6 strikeouts and then maybe 3 singles or doubles. But the math seems to be pretty good. If we do our jobs right and we're at least average, we should be in the 35–40% ROI. That's what we look for as investors. And it's hard work, it's rewarding work, but it's often frustrating on both sides because it would be wonderful to say this is a great idea. Here's a bag of money. Let us know when we get our checks back. But that's just not how the venture world works. There are other people that do that, and God bless them. But that's not what we do. So that's a kind of a 10-minute peek inside our world. And now I think Jody tells us about a far more interesting world of angel investing.
Thanks, Dale. Thanks for taking the time to come here this afternoon. It's always a treat to be able to talk a little bit about some of the things that we do, that we love to do. As Dale says, it's really pretty exciting to work with all of you who bring us great ideas and give us the opportunity to take a look at what you're doing and realize all the exciting stuff that's going on in Michigan. Let me start out by doing a little compare and contrast. Dale talked about the 5 Ps that he looks for. We don't use the 5 Ps, but we look for exactly the same things, starting out with the person. We would say we're investing in the jockey, not the horse. We want an entrepreneur who is so passionate about their idea that they can't imagine that it's going to fail. That's something you're going to work at 7 days a week. There aren't many vacations and there aren't many Saturdays in an entrepreneur's life. And that's what it takes to make a successful company. So we're looking for somebody who is really focused on the success of their business, but with a little bit of actually humility thrown in there. Somebody who is willing to listen to the advice and direction of somebody who's been there before, who has certain expertise, who's able to help. So a little bit of a balance in the person that we're looking for, but that's critical. We also expect them to have skin in the game. How much you invest in your company depends on how many assets you have. We have invested in people not long out of college, and we don't expect them to put a whole lot of capital into their business. We've also invested in cashed out entrepreneurs, and we do expect them to put a lot of capital in their business. I figure your money has to be where your mouth is, and if you're not committed enough to put your money in your deal, why should we? Just in terms of kind of the way the thing works, venture capital is typically, as you know, maybe 2 or 3 general partners who make the decisions. They do the diligence, decide what companies they're going to invest in, whether they're going to follow on rounds, and the money comes from limited partners. So when it's time for a check, they call you up and say, okay, it's time for your 10% capital call. We found another company to invest in, mail your check in. Angels, on the other hand, are very active investors and make their own investment decisions. So we have a common due diligence process and use a common term sheet, which we may do with other investors, by the way, but all of our members, if they participate in the same term sheet, but everybody gets to make their own investment decision. So when we bring a company forward to make a presentation to our members, we don't really know until the meeting is over whether we're going to raise enough capital to actually make an investment in that company. And we will not under-invest. So if the company needs $500,000 and we have $300,000 worth of commitment, we walk away from that deal because you don't want to start your company with less than sufficient capital, and we don't want you to start your company with less than sufficient capital. So unfortunately, those deals we walk away from, but in the long term, it's probably not unfortunate. I think that one of the other key things about working with an angel group is that we have 39 members. That means you have 39 people who want your company to be successful, regardless of whether they've written a check. One of their friends has written a check, and therefore they have some stake in the success of that company just because we're part of the same group. That's also 39 sets of networks. So if one of our entrepreneurs needs a door open somewhere, needs some advice, some encouragement, something that's going to help them be successful, we have 39 networks really to draw on to help make that happen. So there's some really neat things about working with an angel group. Let me think. Typically, we would put 5 people, assume you have about a 5-member board of directors, two from management, 2 from the investors, and 1 business sector expert. So again, we've got at least 2 people, 2 investors on your board who are meeting with you probably monthly and available anytime, and that's probably often weekly phone calls at least. But people who are working with you to try to help make your company successful. The idea in building that board is that we've brought to the table all the expertise that your company needs to be successful. So probably finance, marketing, strategic planning, a variety of things to make sure that what you need is around the table, because you won't have a very big management team. You may have a part-time CFO, part-time marketing person. Could be only 2, maybe 3 people who actually form the company from the start. In terms of kinds of deals that we're looking for, again, a real problem to be solved. We want you to have identified a problem that nobody else has solved and have a unique solution to that problem with some intellectual property protection, which provides a barrier to your competition just coming in and copying what you've done. So that may be a patent or copyright or a trade secret. It could be a variety of ways that you protect it. But you need something that's going to give you some advantage when you get your company off the ground and running. But probably the most important thing, besides the jockey, is understanding your market. Many people come to us and say, well, it's $1 billion market and all I need is 0.01% of that market and I'm going to have $1 million in revenue. Well, no. That's not gonna happen that way. You need to be able to come to us and tell us who's your first customer, who's your second customer, who's your third customer, how you're gonna market to them, and verify that they're actually gonna pay a profitable price for your product. All of your projections, all of your assumptions depend really on understanding who your customers are and how you're gonna get to them, and how you're gonna get them to write you a check that's profitable for your product. All your financial projections, everything else hinge on those first few customers and get built out from there. So it's really critical that you understand that very clearly and that you can communicate it well. Assume that you're talking with a group of lay people. So if you come to us with a life science deal, with a very targeted technology deal, you may be the only person who really understands exactly what you're doing. And you're talking to a group of intelligent people who probably didn't take science or didn't take any kind of a technology class once they graduated from college. You have to be able to get from the simple to the complex, back to the simple. When you communicate your idea, the problem, the solution, and especially and how you're going to get that product sold to the people who really need it. Throwing it up on the internet is also not the solution. It may enhance your marketing program, but it's not the first place you go to sell a product. So again, don't tell us that you've got a great website and as soon as people find it, they're going to be knocking down your door to get your products. A little bit about our process. Our process starts with our website, www.grandangels.org. Our application is on the website, and we have some outlines about our basic criteria. So please take a look at that before you fill out the application. We don't participate in Gossip, excuse me, and those kinds of sites where we're really encouraged to go out and find the deals that fit us. From our perspective, this is a marriage. And we'd like you to go out there and make sure, before you even start the process, that there's a chance that we'll start dating. So don't just throw it out there and hope that I'll look for it and find it. We try to respond within 48 hours if your company does not fit our criteria. And we have a first vetting of any application that we get. And there are a few other pretty objective criteria beyond what you see on the website, but that we've learned to discern pretty quickly. And if there just is not going to be a fit here, we try to let you know that as quickly as we can. If it looks like it might be a fit, I spend some more time on it. We have a vetting team that will spend some time on it. Then it becomes a subjective decision. It may be a great deal, but Grand Angels members may not invest. It just might not be their sweet spot. So we try to, again, make that decision fairly quickly. Our yield rate is about 3% from application to investment. So there are a lot of really good deals out there that we don't do and we can't do. Wish we could, but for a lot of reasons it doesn't fit, and I hate to say no to people like that. But it's the realistic thing, and I'd rather say no to you sooner than later. From that point on, it could easily take 6 months before we make an investment. The due diligence time it takes. See, we meet about once a month for presentations. So getting the company up to a point where we think they're really ready to make the presentation, then we do a much deeper due diligence process with our members. Again, we put together a team, typically of people who are working full-time, maybe in a for-profit job, maybe in a lot of volunteer things, but they're well engaged, and so it just takes time to do due diligence. We also want to take the time because we want to get to know the jockey, we want to understand the business. And frankly, you're busy full-time. Just because we ask for certain things doesn't mean in 24 hours you're going to be able to turn that around either, or should turn that around. So there are a lot of things that stretch this thing out. It's nice to see whether there are customers who begin to show some interest and some possible validation. We really like a company to at least have a beta product out there, tested by customers, if not a little bit of revenue. Our target, our range of investing is about $250,000 to $750,000, maybe $1 million if we co-invest with another angel group. The $250,000 for several reasons. First of all, it takes time and money and attorney's fees and other things to do a deal. So less than that, and it really isn't very cost effective. It's also true that if you don't need about $250,000, you're probably not really ready for angel money yet. You start it normally with your family and friends money, and then you go to angel money, possibly venture money. After angel, most likely not. Most of our deals actually never get angel money, venture capital money. So we're hoping to be able to put enough money in your company right from the start that will get you to cash flow positive. So you don't have to turn around in 12 months and do another capital raise before you can move your company forward. You probably tranche it so that there are milestones and you don't get the full amount of money up front. We're trying to put you and us in a position where your company is at least profitable, if it doesn't happen to scale for whatever reason. I think I've probably taken all of my time and a little bit more. There'll be time for questions afterward, and I'll turn this over to Michael.
Hello, my name is Mike Keurig, and I'm going to be talking to you about a different type of funding called non-dilutive. So for this money, you don't have to give up part of your company, and you don't have to pay it back. So it's not debt, it's not equity. These are typically grants for businesses, typically small businesses. So in that sense, the money is free, but it's certainly not easy. They're typically very competitive programs, and you have to do a lot of homework in terms of developing a strategy to secure this grant funding. If you haven't learned it so far, you probably will soon find out that finding early stage money, especially where there's a lot of technical risk, is a very difficult job. And by that I mean, you may have a great idea, but if you can't demonstrate that your technology works in a very concrete way, you're going to hear the same story from investors. You're too early. Come back when you can show me that it works. And better yet, come back when you can show me you have a customer. One of the few places to find this kind of high-risk funding is from two federal programs designed for small businesses. They're called the Small Business Innovation Research, SBIR, and the Small Business Technology Transfer, STTR. These two sister programs result in awards of $2 billion plus a year in the U.S. So that involves participation by 11 federal agencies. They award between 6,000 and 7,000 awards per year to small businesses, meaning companies that have less than 500 employees. And the awards are made on the basis of a national competition. So the basic eligibility and the operation of the programs is administered by the Small Business Administration, but each of the 11 agencies can customize the rules to fit their particular needs. So, for example, agencies that are mission-oriented, like Department of Defense and NASA, have very specific problems that they're trying to address. And they publish topics and that describe the problems and the way they've tried to solve them. And they're asking for new approaches. They're saying, we need new ideas in solving this problem. And your proposal has to address very specifically that particular topic area. For other agencies, like Health and Human Services, their charter is very broad. And they want to hear any idea that has anything to do with human health. So if your idea has application in that area, they want to hear it. All of these programs are about innovation and about economic development. The government's not expecting a financial return. They're not going to take a part of your company. They're not asking for royalties. But they do expect you to generate economic activity, create jobs, create new products, and possibly create new industries. That's why they're making the bet. So they have their own agenda, if you will. And the key to being competitive here is not telling them what you want to tell them, it's telling them what they want to hear. So you have to understand their problems and their needs, just like you would for any customer. So of the $2 billion that are awarded every year, 75% of it comes from the two largest agencies that participate. The Department of Defense awards about $1 billion in these SBIR, in their case, contracts, but it's still free money. But you have certain deliverables to meet as part of those contracts. The second largest agency is the Health and Human Services, primarily the National Institutes of Health. They award approximately $650 million a year in the form of grants. It's a two-phase program. Phase one, they ask you to demonstrate the feasibility of your idea, of your technology. So they only give you up to $150,000 to demonstrate that feasibility. If you can do that, you're eligible to apply for a phase two, which is $1 million and typically 2 years. So if you look at the entire project that you're proposing, think of a 3-year project with a budget of about $1 million to $1.2 million, in that range, right? In terms of the intellectual property that you bring into the project, first of all, you must have the rights to practice the technology. If you didn't invent it, if you've licensed it somewhere else, you need either a license or an option so that you have the rights to practice that invention. Any new inventions that are made during the project belong to the small company, not to the government. So you have the rights to file patent applications on any new inventions, but you cannot use the funding from the SBIR program to pay for those patent applications. One of the disadvantages of the program is that it will fund only research and development and expenses directly related to those projects. It will not fund your patent applications, it will not fund your market research, it will not fund your executive salaries, unless your executive is a VP of R&D who's working on the project under proposed. So these two programs, so SBIR has been around since 1982, has been very successful in terms of delivering innovation from small businesses, creating jobs, and in some cases, as I said, creating industries. For that reason, it was recently reauthorized, and the programs will exist now until September of 2017, with some changes. The biggest changes are positive. Number one, they're going to be increasing the funding gradually over the next 6 years, so that by 2017, it's estimated that the government will be awarding about $2.8 billion under these programs. The other change is that companies that are majority owned by venture capital investors can now participate in SBIR in two categories. For 3 agencies, Health and Human Services, Department of Energy, and the National Science Foundation, they are permitted to award up to 25% of their SBIR budget to venture-owned companies. All the other agencies, the other 8 agencies that participate, are allowed to award up to 15% of their budgets. There are actually only 5 agencies that have STTR programs, and the reason that was created is because the government also wants to encourage small business to cooperate with universities and other nonprofit research organizations, because they think that cross-fertilization leads to better and faster innovation. So 5 of the agencies that award more than $100 million in SBIR awards also have an STTR program that requires a collaboration. The SBIR program, the small company can do all the work on its own, or it can choose to collaborate or subcontract. It has that choice. And the STTR, you must work with a nonprofit partner. So, successful getting grant funding, you still have a bit of a problem because although that'll cover your R&D costs, it will not cover any of your business development costs, and you should be doing both simultaneously. There are other sources, and you're going to need to find other sources to fund those other essential activities, like market research, like your patent protection, and the other things that I mentioned. Fortunately, there are programs both locally and regionally that that provide those type of more flexible funds where you have more choices in how you spend that money. I'm going to let Skip tell you about those in this next session.
Well, good afternoon and welcome to ACE. I'm sure many of you have been here before, but this is just, this is what the 12th annual, and every year it just keeps getting bigger and bigger. And all it does for me is pump me up, get me excited about all the work that we've been doing in this state for the past many years and creating an environment so that we can have this many entrepreneurs come in one place once a year and celebrate our success and growth. Because, and I've been saying this for several years now, and I actually have never been challenged on it, and in fact it's been supported. There is no better place than the state of Michigan in the United States of America to start a company in 2012. Because of the ecosystem and all of the support structure that's been built over the past decade to support your endeavors, your activities, and get you launched. So, my job today is to kind of give you an overview of all that is available to you out there to take advantage of. Whether or not you do it is up to you, but there's plenty out there to choose from. I'm going to start with an organization called the SBTDC, Small Business Technology and Development Center. It's funded largely by the SBA. Free service. What they provide is a lot of counseling and guidance. They don't do the work for you, but they can make sure you're on the right path, headed in the right direction in terms of your creating your business model, your business plan, your strategy to go to market, your product development, a roadmap for that product, for your technology, etc. Statewide, anybody, anywhere in the state can access those individuals, those professionals whose job it is to help you get to the next step. And from the earliest of stages, while you're still developing and finishing your business plan and your strategies, etc. The state created about 10 years ago what are called smart zones. It's a network. Today there's 14 of them around the state, and that is a collaborative activity between a business accelerator, economic development organization, and the university in that community partnering together to commercialize the technology that is evolving in that community. It's very geographically focused, but the roots, the connections inside the university, particularly access to everything that our universities has to offer, what the community has to offer from a business development standpoint. They're working together and to help you get from research into development, from development into commercialization. That's the purpose of the smart zones. And like I said, they are geographically limited in a way, in that their funding is very limited to companies that are starting up within their particular geography. So Ann Arbor has one, Tech Town in Detroit, Houghton has a smart zone, etc. There's 14 of them around the state. If you're not near a smart zone, or if you're not in one of those communities, a brand new program that was just launched a month ago allows you, if you happen to be in Adrian or West Branch, not anywhere near a smart zone, but you've got an innovative technology company that has great potential, and you can use those services. You can use a consultant who actually gets in and works with you side by side to help you move that your company forward, who may get in there and help you hands-on with your marketing strategy, with your product development strategy, making introductions for you to potential manufacturing partners, possibly investors, maybe even opening a door to that first customer who's willing to take a look at your and use your beta product. There's a program now where you can find a business accelerator somewhere near you and started your local economic development organization, and they should be able to tell you who that person or organization is. And then they can access this new state program that will provide those same services that the smart zones can provide without you having to have your business physically within that community. There are advantages to being within the smart zone, but now there's funding that the state's provided to you no matter where you're located. So that geographic limitation largely is now gone. And that's free. It may cost, it's costing the state, it's costing your smart zone, it's costing that business accelerator organization cash because they're paying those consultants who are assisting you and moving you forward. But there's no obligation to you. That cost is covered by them. You don't have to pay it back, no obligation. Our expectation is that you will succeed. You're going to grow, you'll create jobs in that process. We've got a lot of incubators around our state. We've got a lot of kitchen incubators that have evolved over the past couple of years. If you're interested in the catering business, the restaurant business, there's a lot of those around the state. There's also a lot of technology incubators located around the state. Spark happens to manage 3 of them. We've got a wet lab life science incubator in Plymouth. We've got an innovative incubator in Ypsilanti, and we've got a technology-based incubator in Ann Arbor. What do they all have in common? Well, it's an opportunity, it's a place for you to land when you're ready to move out of your garage. It's inexpensive. We don't compete with the commercial landlords in your community. That's not our intent or desire. In fact, our intent is just the opposite. We'll give you a short-term landing place for your business with the expectation in a relatively short period of time you move into the commercial sector and pay real rental rates in the commercial sector. But in that interim, you need a business address. You need your own phone number. You need a conference room. That's what these incubators will provide you. And usually coming along with them is some kind of assistance, some kind of mentoring, or at least critiques as you're growing and helping you along the path. That's provided in these incubators as well. Then business plan competitions. There's a debate right now whether or not we have too many. And there are a lot of them. All I can tell you is take advantage. Free money. You win, get a check, put it in your bank account, do with it whatever you want, no strings attached. Apply to all of them. One of the things we're all trying to do with all the various business plan competitions in our state is kind of coordinate what it is you have to submit to compete so that you're not having to write a business plan for this competition and rewrite it completely for this other business plan competition. We're trying to get them in sync so you don't have to keep rewriting it. You can actually use the same business plan for the GLEQ competition and turn around and use it again for the Accelerate Michigan business plan competition. The nice thing about the GLEQ is that it comes with a mentor. Part of their whole program really isn't their awards at the end, but it's the mentoring. It's the volunteers that help you with your business plan and developing it as you prepare for the final review and competition at the end. On the other extreme is the Accelerate Michigan Innovation Competition in the fall. They don't provide that, but they've got a big pot of money. They distribute $100 million to 15 companies in Michigan each fall. The universities all have business plan competitions for their students. In fact, some of the universities have multiple business plan competitions to participate in. My point being is, there's a lot of them. Take advantage of it. It's free money if you win. And it's a good exercise for you anyway, to kind of go through that. And because you're going to learn at the end. So even if you don't win, in most of these competitions anyway, you'll get feedback as to maybe why, or you came up a little bit short, what you need to work on, what you need to change. In terms of other cash in your bank account, what Mike was talking about with the SBIRs, the state created a fund 3 years ago, maybe 4 years ago now, called the Emerging Technology Fund. It's specifically a grant for SBIR award winners who are in Michigan. So you go out, you apply to the DOE for an SBIR Phase 1, you win that award $100,000. Well, this program provides you another $25,000, as a grant to cover your operating costs and those things that Mike described that the SBIR wouldn't cover. So the marketing things to get you to commercialization that the SBIR grant won't cover, then you've got this little bit of money for that purpose. That's state money. If you get a phase 2, you can get up to $125,000 for that purpose. Now, the one thing you've really got to drill into your head, though, and remember, is you've got to apply to that, for that grant, before you apply to the federal agency that you're applying for the SBIR. They're kind of sticklers about that. You can't wait until you find out if you win, and then come and get the grant. It doesn't work that way, it's the flip. Just remember that key little element. But nonetheless, grant, free money. The last two programs we want to talk about are not grant, it's not free, but it helps you at a very critical stage in your growth. State recognized a long time ago that they saw early on when the VCs started waiting later to invest. The days of the VCs writing checks, even small ones, early on, way before you have revenue, way before you have a customer, those days are largely gone. There's still a few VCs that might do that, but there aren't many. And as Dale said earlier, they want you to already have some revenue. They want you to have customers. Even the angel investors, many of those are expecting the same thing. So what do if you're in that gap between, I now have a developed product, it may still be beta, it still needs to be tested, but I don't have revenue yet. How can we bridge that? So what we've created, the state, your state has created, one, a microloan program where you can borrow up to $50,000 to help you finish the development of your product, to help you pay for operating costs such as travel, such as trade shows, such as finishing that market survey, such as doing an FTO, freedom to operate kind of thing. We won't pay for patents, but we'll pay for about everything else you need to get to commercialization. By the way, commercialization, by our definition, is you either are able to raise outside third-party professional private equity, or you're able to partner with a corporation or some larger company that's able to take you further to the next step, or you actually have customer sales. If you achieve one of those three things, in our view, you've reached commercialization. It's at that point that Jody and Dale become very interested in you, and you can have serious dialogue about taking you to the next level. The goal of all of these programs is to get you there so that at that point, the marketplace determines your fate. At that point, the private sector takes over, and you will succeed or fail, and our goal is to make sure you're in a position to succeed. So, the small loans is one way of providing you that early stage, a little bit of capital. It is a loan, you do have to pay it back, we want that money back. The other program is the pre-seed fund, which is a co-investment fund. It's up to $250,000. We'll provide as a match investment with another investor that is generally your first round of outside private equity. So when you're out raising that first $500,000, for example, you raise $250,000 from some source, and then you can apply to the pre-seed fund for a matching up to $250,000. We get the same terms you've negotiated with that other party. So we've taken ourselves, this program's taken itself out of negotiating terms. We don't do that at all. We just get whatever you've already negotiated with the other party. We also require you, though, to go get that money first. It's not the other way around. We won't approve you for an investment so that you can then go get it. We want you to actually have the experience of going out and raising money. And again, your Smart Zone, your Business Accelerator, we're all there to help you raise that money, or at least be prepared to go raise that money. And so that's the last of the programs that is available to all of you, no matter where you are. You just have to be a Michigan-based company. And that's kind of all the things that are available to you to get to commercialization. At that point, we're kind of done. And and we let the private market take it from there. And we hope all of you are successful. All of you give us a nice return on our investments. All of you return and are able to pay back our loans. And all of you become great successes for our state. And we grow our employment, we get back down to 3%, and all that other good stuff.
Thank you, Skip. By the way, I forgot to introduce myself. I'm Andrew McComb. I'm a managing director of one of the local venture capital firms as well. We have offices in Ann Arbor and Cleveland, which makes it interesting when they play football, but that's... so anyway, questions. We've just covered everything from basically venture capital all the way to sort of the earliest stages of funding, including government. Yep.
How does the new startup Michigan get develop all of this? I don't know who would know the answer to that. I guess they're introducing it today, but is there any feel for that? Maybe Skip.
Well, we'll learn a little bit more today when Steve talks. It's a federal program. It's a private initiative, although, you know, the president's endorsed it. Feds have endorsed it. You know, they want to see it happen, but it's really a private initiative. And it's really, and it's not, as I understand it, there's not going to be a lot of capital tied to it, but it gets back to that door opening opportunity. You'll have access to a lot of things at a federal level with that program. We'll be able, Michigan, by being a participant, will be able to tap into their resources and therefore expand all those things we can refer you to and expose you to.
Yes, sir.
Yes, I had a question to ask Mike about SBIR. You talked about RFP, which is request for the proposal. Okay. And you also talked about the customer or potential supporter is Department of Transportation and Department of Defense. Now, here is the problem. How can we find out? What kind of problem over there? Is there any of the specific link you can tell me? I have second question.
Yeah, so the question is, how do you find out what problems the federal agencies have and they want to see proposals on? All the federal agencies that participate in the program publish solicitations. They also have websites specifically for their SBIR programs that have more information than you would even like to read, but there'll be plenty of information about the topics. The other thing we always urge you to do is to contact the program manager responsible for the SBIR program at that agency to talk about the idea that you're going to propose and whether it's responsive to what they need.
There is two steps. One, defined is the minimum viable product, which is we have. Our product basically solve highway traffic jam, have the potential to solve the highway jam, which is worldwide. Now, here's the thing is that we really need to some kind of protection using the patent law, and have to be international because of highway jam is all over the world, especially in China and India. With that, quite big chunk of money, which is basically for IT. In that particular case, how we can work with the potential supporter, and to the early stage, he explained this thing. It can be useful, however, it is tough, but protect ourselves.
Yeah.
Our technology is very simple.
It may be very useful and very innovative, but if all you need is funds to protect your IP, the SBIR program is not for you. Those are research and development funds. So they expect you to be doing research, developing products. If the product's already developed, they're not going to pay you to protect your IP.
And I don't know of any program from anywhere that will actually provide you funds to pay the patent office. They may help, you may be able to find some funds that would subsidize legal fees in preparation to file. And maybe you can find some funds to help you with your freedom to operate. But you will not find any money that will actually pay for the filing costs for the patents themselves. themselves.
This is what Jody referred to as skin in the game. So, I mean, at some point, it's difficult, if not impossible, to do this for free. And just, by the way, here's a bit of a plug as well. Biotech Business Consultants, who Mike works for, has a grant from the state to help companies get federal grants. They also run a seminar series. If you're thinking at I took one of their seminars probably 7 years ago. But if you're thinking of doing any work in the federal grant space, take one of their seminars. It's really well worth it. This is not something you want to try and just figure out on your own. Get help. It is Byzantine. Yeah.
Question. We've actually utilized a diagnostics discovery company. I've actually worked with Mike, not that I'm getting paid as anything like that, but we've gone after a lot of different funding opportunities, both from government and private sector, and we found that a lot of the people want to put money in, they want to have a client, they want to have a deliverable, they want to have some revenue, and at least in the diagnostics or even in the therapeutics, there's that chasm of time until we actually get to that point. And the funding streams for putting money into, so to speak, these ventures that have not yet created any type of revenue stream, it's hard to find those groups. Most people will say, yes, I'll give you $50 million if you're in a phase 2 trial, because the probability of scoring is much greater. It's this small, it's very small, but it's much money, and it's a very deep chasm. I'm just wondering how the marketplace is going to find people who invest into these companies such as myself without a revenue at this point, because you need FDA approval and all these things, is very difficult. So I'm just wondering if there's another, how to find people who will invest into this venture space.
Well, as Dale mentioned, all venture capitalists deal with specific areas. We don't do therapeutics because we're not smart enough. We've got nobody in our group that has a PhD in molecular biology. But the other problem is the issue that you just raised, is that it's a difficult space to fund. There's a lot of different strategies out there. Dale could probably speak more to it because he deals more in life science. We do med devices, which are a different sort of kettle of fish. But one thing that I've seen done a lot on the biotech side is actually licensing out a bunch of compounds early on and using that licensing revenue to move the main compounds forward as a strategy. I mean, it is, there's, Dale, do you want to comment on the easy way to do it?
Start off with a lot of money. That's the easy way to. We do that investing. We did therapies, type 2 diabetes drug. We're looking at another one right now. But you're absolutely right. As Amy said, it's a time value of money issue, because you have to look at the size of a fund, right? We're a very, very small fund, and knowing that these things take $50, $100, $250 million to get to a proof point where you can get an exit, 2A, 2B, 3, whatever, wherever you are in that FDA thing. That's part of the discussion that every investor is going to look at. Where is the value inflection point that some buyer is going to say, you've done it, that's it, now that's just enough for me to buy it. And the earlier that you can buy it, the cheaper you can buy it, right? So there's that risk-reward issue in there. But you're right, that is, as Amy said, there's a small group of folks that will do it. But it is rich, rich territory when you hit. I mean, you don't need, there are a couple in the state that are great, great success stories. And Aspirion is the one that you talk to. So if you, Aspirion. So if you don't know Roger Newton, stalk him. He's your guy, right?
Yes.
So on the opposite end of the spectrum, a number of us, including myself, came from the lean startup panel, and where we're encouraged basically to go out and get traction by putting things in the market without doing a business plan. So as investors, people that put money into companies, do you still look for business plans, or is that starting to change? That was a question there that.
Yeah, I mean, it's got to be at least 30 pages, single space.
A lot of arcane technology.
The reality about business plans, I mean, the others can speak to this, but this is how I use a business plan. I'll look through it, and I'll try and get a sense of how well you know your customer, your product, your market, and what's your thought process. Like for example, the long spreadsheets of numbers and so on and so forth. Everybody knows that those are wrong. They're high or they're low or there's something in between, but they're not exactly correct. But really, what's important is the thought process behind it. Okay, I've spent 10 times as much in my life doing startups as I have actually being a VC. I've only been in venture capital for a couple of years. I'm a newbie. But I ran service companies, and one thing that I've yet to see somebody do is hire a salesman and get revenue the same month. Okay? I could never do it. I've never seen anybody else do it. But boy, I see a lot of business plans that have hire salesman month 1, revenue month 1. Okay? Just little things like that.
I'd like to comment on that. Business plans are important for 2 reasons. One, they articulate what your vision is. And if you can articulate in a way that we can understand it, because we're just lay people, oftentimes, if you can do it, then you've demonstrated that you can speak a language that others can understand. Why is that important? Because that means your customer is likely to be able to understand that same language. And the other point is, it forces you to think through what the issues are. And Skip's scoring sheet for the pre-seed fund is one of the best I've ever seen. It's broken down into 6 categories about the different things that are interest, and we as judges score those things. And it's largely based on what the vision of the company is, and it's really the sales process. We as early investors want you to understand how the hell you're going to sell it. Danny said you're going to be wrong, right? The numbers are wrong. Every projection looks like this. Boom! Right there, right? Everyone's a hockey stick, so you go, all right, whatever. Right? But looking through how you built that up, and Andy said that the subtleties are so critical. How long is it going to take to get the customer? What's your revenue model look like? Are you going to sell it at a 95% margin? No. So as long as those things are there and you can justify them, they can be high, they can be low, but if you can justify them, you have a conversation that is meaningful. If it's just something where you just put a lot of crap out there, we've seen a lot of these things. We've seen a lot of plans, so the BS meter goes off. It's very, very sensitive. So if you don't know it, don't make it up, right? That's one thing I would say. Just don't make stuff up.
Yeah.
Yeah, thank you. I have a question to ask you, Judy. About, you have 39 members, grant analysts. Your portfolio, is there any your company you support in manufacturing, especially in lighting display and LED stuff?
Yeah, you're basically asking if we invest in manufacturing at all?
Well, first of all, you can answer my question is that your portfolio is focused software, medical or bio, or is there anything can manufacture something in this country which is your support?
Yeah, we are not sector focused. So we obviously, we don't invest in lifestyle businesses. There are certain areas we don't invest in because we don't understand them. Manufacturing is one thing that people in Michigan understand pretty well. And so given the right opportunity, we invest in manufacturing.
Okay, last question? Yes.
I have a quick question. So I run a software company right here in Denver. We're pretty profitable. We have an office, a backup center. And sometimes we get ideas that we want to launch, that we want to get venture investor for. But at the same time, we already have this company that I'm running that's been running for 4 years and it's been doing pretty well. So if we went out and looked for venture funding, what would we have to do with the current business since I'm also running that business?
Choose. I think that's the short answer. Focus is an issue. We're not a bank where you just go and try stuff out. This is not a situation where you think it's a good idea. Here's a bucket of money.
Sure.
It's the fact that you're doing a business is important. What would be of value is if you said, we got it to an alpha, we got it to a beta, we've got a first customer,
Sure.
now we're ready to scale. and it's become part or the focus of our business.
Yeah.
That's an important conversation. If it's, well, this is a distraction, it's a neat little thing, you know, but build us a sandbox, that's not of interest.
Yeah, because we built our business without any investment. We just kind of grew it ourselves.
Congratulations.
Within the 4 years, and we're self-funded.
That's pretty
Great.
cool. Yeah.
And now we want to, you know, we come into the office sometimes and say we have this grand idea that we want to build or we want to look for investment. So I guess that's what we're just looking at our options to see whether we have to give up this or what an investor will require us to do with the current business if we don't.
Well, is it a product line extension?
What is that?
Is it a product line extension?
In a way it is. I mean, we make mobile apps mostly, and we also have a consumer site that does pretty well. And it's an extension of our business because it is in the consumer internet space.
Yeah, well, in that case, you might be looking at something more like growth capital,
Sure.
where you've got it up to a certain point, and you're looking for capital to grow the business into something larger.
Yeah.
Okay. Now, if it's orthogonal to what you're doing today, then as Dale said, choose.
Okay. Sounds good.
Okay, thank you very much. I don't like the